then China also had an additional 10, so it's 10 plus 10.
If Trump is imposing tariffs, we're ready.
U.S. China trade war, a game-changing economic battle, a new chapter in global trade conflicts. The United States and China have once again locked horns in a trade war that is sending shockwaves through global markets. In response to the latest tariffs imposed by the U.S., China swiftly retaliated with additional tariffs of its own. This tit-for-tat economic battle is no longer just a disagreement over trade policies. It has escalated into a full-fledged struggle for dominance in global commerce. With both nations imposing high tariffs on each other's goods, industries across the world are feeling the heat. American businesses are grappling with rising costs, disrupted supply chains, and economic uncertainty. Meanwhile, China is using its control over key resources, such as rare earth metals, to strike back, making it harder for U.S. manufacturers to secure essential materials. The result? A global economic shift that could reshape industries for years to come. How the trade war escalated. The conflict began as a U.S. strategy to protect domestic industries and reduce trade imbalances with China. The U.S. accused China of unfair trade practices, including intellectual property theft, state-backed subsidies, and market restrictions. In response, the U.S. imposed tariffs on a wide range of Chinese goods, some reaching as high as 25%. The goal was to pressure China into changing its economic policies. However, China did not back down. It retaliated with tariffs of its own and took further steps by tightening export controls on rare earth metals, critical materials used in electronics, defense, and electric vehicles. This move sent shockwaves through global markets, as China holds a dominant position in the supply of these essential resources. Impact on global supply chains. The trade war has thrown global supply chains into disarray. Many industries, especially technology, manufacture, and automotive, have long relied on Chinese suppliers for affordable raw materials and components. Now, with tariffs raising costs and export restrictions creating shortages, businesses face tough choices: absorb the financial burden and risk lower profits, pass the added costs on to consumers, leading to higher prices, move production to other countries, which requires significant investment and time. Some companies have begun shifting production to nations like India, Vietnam, and Mexico to avoid the risks of U.S. China trade tensions. However, relocating factories and building new supply chains is neither cheap nor easy. Infrastructure, labor availability, and logistics all pose challenges, leading to further inefficiencies and long-term instability in global trade. How consumers are affected. For everyday consumers, the trade war has led to rising prices on essential goods such as electronics, automobiles, and even groceries. Businesses struggling with increased production costs are passing those costs on to customers. Additionally, supply chain disruptions have caused shortages, making certain products harder to find. The automotive industry has been particularly affected, with tariffs driving up the cost of imported vehicle components. Car manufacturers are raising prices. New car models are facing delays, and the shortage of semiconductors has further worsened the situation. Even the used car market is experiencing inflated prices due to limited availability of new vehicles. Beyond cars, consumer electronics like smartphones and laptops are also becoming more expensive. The shortage of rare earth metals, key ingredients in tech products, has slowed production and created uncertainty in global supply. Even medical supplies, including syringes, needles, and protective equipment, have seen price increases due to trade restrictions, making healthcare more costly, stock market volatility, and investor concerns. The financial markets are reacting sharply to every new development in the trade war. Stock prices fluctuate as investors try to assess how tariffs, supply chain disruptions, and geopolitical tensions will affect corporate profits. Many multinational companies, particularly in the technology and manufacturing sectors, rely on China for a significant portion of their revenue. With tariffs increasing costs and disrupting trade, profit margins are shrinking and production is slowing down. As a result, stock prices have become highly volatile, making it difficult for investors to plan for the future. China's countermeasures and strategic moves. China is not just retaliating with tariffs. It is also rethinking its economic strategy. One of its boldest moves has been tightening control over the export of rare earth metals, which are crucial for industries like semiconductor manufacturing, electric vehicles, and defense technology. By limiting access to these resources, China is putting pressure on the U.S. and its allies. At the same time, China is expanding its trade relationships with Russia, Middle Eastern nations, and countries in Africa and Latin America. By strengthening these economic ties, China aims to reduce its dependence on U.S. markets and create new opportunities for trade and investment. Additionally, China is accelerating efforts to develop its own high-tech industries. The government is investing heavily in artificial intelligence, quantum computing, and semiconductor production to reduce reliance on American technology. While this transition will take time, it signals a long-term shift in the global economic landscape. The global domino effect. The U.S. China trade war is not just affecting these two countries, it is causing ripples across the global economy. Other nations are being forced to rethink their trade policies, strengthen domestic industries, and seek alternative trade partners. New manufacturing hubs. Countries like India, Vietnam, and Mexico are attracting companies looking to move production out of China. European Union's response. The EU is imposing tariffs on Chinese electric vehicles while investing in domestic battery and semiconductor production to reduce dependence on China. Japan and Taiwan strategy. These nations are boosting investments in semiconductor manufacturing to maintain their competitive edge. However, shifting supply chains away from China is not a simple fix. It requires significant investment in infrastructure, labor training, and logistics. In the short term, this transition is leading to inefficiencies, higher production costs, and slower innovation. Is this the future of global trade? The trade war has exposed the risks of over-reliance on foreign supply chains, pushing many countries to prioritize self-sufficiency. Governments are offering incentives for domestic production, but this transition is expensive and time-consuming. Higher labor costs and increased production expenses make it difficult for businesses to remain competitive. While some argue that reducing dependence on China will ultimately strengthen local industries, the immediate impact has been economic instability, rising costs, and global trade fragmentation. The big question remains, will these changes create a more resilient economy in the long run, or are we heading toward prolonged economic uncertainty? One thing is clear. The U.S.-China trade war is reshaping the future of global commerce, and the world is watching closely.